hi everyone, and welcome back. You're watching The Money Show on ET Now. Okay, well, since we just have a couple of days to go before the 31st of July is upon us, and yes, folks, that's the last date for you to make your tax-saving investments for the year FY20. Yes, FMC Tharaman has allowed you a few extra days as, one does acknowledge that this the lockdown may have led to a bit of a cash crunch for a lot of individuals, and hence they may not have been able to make their tax-saving investments. So let's talk then about the options before assessees to clear out, or rather to make the tax saving investments. What are the options before them? I have with me Preeti Khurana, tax expert with ClearTax. Preeti, thank you for patiently waiting by. Apologies for the delay. We had a slew of results and breaking news coming our way. So Preeti, to start off with, it's important to understand that while we still have maybe 4 to 5 odd days left before the 31st of July, we are still in the midst of a lockdown. Many services are still not completely open, and it's always best for individuals to avoid venturing out unless it's extremely important and urgent. So what are some of the most convenient transactions for tax saving investments that can be conducted given the limited resources that we are dealing with?
Right. So firstly, I would like to encourage all taxpayers to do their tax calculations. This is an ideal time to look at your Form 26AS, take out your Form 16s, and then find out how much tax do you really have to pay. So that's the first step. Once you've identified your total tax outgo, look at a few things which are very, very critical. The first one is trying to maximize Section 80C. So that's the section that gives you rupees 1.5 lakhs worth of tax deduction. Try and maximize that. How you can sort of maximize it is using those typical ways of making a deposit to your PPF account. Now, as you said, a lot of people may not be able to go and physically visit their banks, but a lot of banks actually allow online deposits. You can even make an online transfer from your bank account to your PPF account. So do that. If you do not want to get into PPF, you can obviously consider ENSS. Look at a good equity-linked savings scheme. Buy it online. You can absolutely do it online in a few minutes, I should say. These are the two most important things. So firstly, identify what is your tax outgo, and then make sure you're maximizing Section 80C. If you have an NPS account, then make sure you make the NPS deposit. You can actually create an NPS account in completely paperless fashion. Online, you just may have to fill up a couple of forms and perhaps interact on the telephone. That's what's required to do your NPS. If you want to do any post office saving schemes or other senior citizen saving schemes, those may have to be done physically. Senior citizens can look at doing the 5-year fixed deposits. I think those are the very important ones. And then, of course, comes health insurance. If you still haven't considered a health insurance, you should do that. Look at policies online, and perhaps you will be able to make a purchase in a completely paperless fashion.
Preeti, follow-up question. Between PPF and a 5-year fixed deposit, since it's a 5-year fixed deposit, obviously your money is going to be locked in over there as well for a long period. I mean, we're talking about 5 years. PPF, of course, it's for a longer duration, but then again, you can withdraw small portions of your corpus, after, a couple of years have passed. But yeah, we have, firstly, FD rates have really, really gone down. But PPF rates still had that little bit of stability in them. Yes, even the government had revised PPF rates to extremely low levels, but the advantage over there is significant, especially in terms of a tax point of view, which may not be available on the interest that you earn in a bank FD. That will be limited only to when you make the bank FD. So between these two, what would be your preferred option?
Right. So both these products are actually for those who are risk averse. If you're looking at minimizing your risk in terms of keeping your principal intact, then definitely both PPF and fixed deposits figure in that list. PPF traditionally is an investment where you invest religiously. You're depositing 1.5 lakhs every year for up to 15 years. You can extend it further. So typically, in your total portfolio, PPF definitely has an important role to play. It's one of those fixed income instruments. Any returns that you have from your PPF account are not taxable. So that's the advantage. Withdrawals are tax-free completely, and that's why people go towards PPF. So diligent investing, year on year, you do 1.5 lakhs, and you can go up to a longer time frame and build a huge corpus and have all the interest income, which hovers somewhere between 7 to 8%, and definitely, as you said, likely to be even lower in the coming years. But you can consistently go and deposit for a period of up to 15 years and further extended. FD, on the other hand, is more suited to senior citizens, who are looking at, sort of having an easy access to capital, making that deposit if need be, and actually, having easy access to money, who are not looking at a long-term commitment. Typically for those is what 5 years fixed deposits offer. They will also have slightly better rate for senior citizens, and I think that is a better option if you are more than 60 years old and you're looking at easy access to your money short term, in the sense of 5 years. Then go for fixed deposits. But most investors, even young older ones who are looking at building a long term corpus and have PPF as part of their overall portfolio as a fixed income resource, which is going to build up a huge corpus over the next couple of years, next decade or so, then go for PPF. So if you already have a PPF account, then make the minimum deposits, which is actually pretty small. It's just 500 rupees. But if you've still not exhausted your Section 80C and you have a PPF account, then in my view, making a deposit to PPF is definitely better. You're looking at a 7% return, which is not, taxable, and then you can withdraw in certain situations. If you have certain eventualities and you need the money, then you may be able to withdraw from your PPF account.
One very important thing to understand is that for people who've already opened their PPF accounts, if you opened it maybe like 4-5 years ago, you've enjoyed interest rates at 8% as well. That was a good high that PPF interests were paying when interest rates as well were at that high level. It's only, of course, recently that interest rates are just about that 7% mark. But yeah, again, like I mentioned, if you've already opened your PPF account, the timeline has already started. So you're that much nearer to completing, that 5-year, 10-year, 15-year period for a PPF. And additionally, like Preeti as well mentioned, exempt, you get a benefit when you invest. The interest as well is absolutely tax-free. And then when you have to withdraw your PPF amount as well, or after 15 years or for whatever purpose, that as well is absolutely tax-free. So I think that's a big benefit, of PPF. Okay, Preeti, I want to talk to you about the change in dates that FM Sitharaman, or the relaxation in deadlines that FM Sitharaman has allowed because of, the COVID pandemic. So earlier, we would have actually had to file our returns by the 31st of July. The conversation that we would be having is perhaps how to pick the income tax form that I should fill out based on my sources of income. But that conversation, I guess, now has been pushed to perhaps more like October and November. So the question over here is that usually your very first step, like you mentioned, when I want to make my tax saving investments, is calculate what is my tax liability. Let's say if I have not covered it all up via TDS or via advanced tax payments, I will still have a little balance to pay. Ordinarily, I would have to pay it before 31st July. But now that I have to file my returns on the 30th of November, can I pay SA tax as well? A little later, especially if I'm facing a bit of a cash crunch and every penny is important to me. So can SA tax as well be paid later? And if yes, what are the implications on penalties or interest?
Right. So firstly, I would advise all taxpayers, as you said, to calculate their total tax dues. It's very important to, identify all your sources of income, look at interest income, look at fixed deposit interest income, download your Form 26AS and estimate your total tax liability. Most of us end up doing this exercise only when we are doing our tax returns, and a lot of people have actually started filing their tax returns already. Now, if you have any tax due, best is that you pay it right upfront. While the government has said that those who don't have a tax liability beyond a lakh may still have the flexibility to pay it without any penal interest. But if you have any tax dues, please estimate and calculate them and pay them. There are a couple of reasons for that, which is that you also have an advanced tax liability. So say if you had a certain income and you did not pay taxes when they were due on the quarterly basis, you may still end up paying certain penal interest because of delayed payment of tax. So overall, if you have any taxes due, please go ahead and pay them. There is a threshold, but my advice to everyone is to estimate their tax liability and go and make a deposit right away.
Okay, all right, fair enough. So that's of course on making your SA tax payment, and how you should essentially do that. All right. Well, let's now talk about another section that has been introduced with effect from the 1st of July, and that's section 194N, an amendment to TDS. So what exactly would you advise viewers when it comes to this? I mean, if you could just break it down for our viewers.
Right. So just to understand it very simply, section 194N has been brought into the Income Tax Act to make sure that people are not transacting in cash. That's the idea, to promote digital payments. Now, what this section actually says is that if you're making withdrawals exceeding ₹1 crore in one financial year, then the person who's giving that money to you, the person from where you're withdrawing, could be a bank or a cooperative society or a post office, such an entity will make a TDS deduction of 2%, right? So that's the broad premise, that if you're making withdrawals, and it's applicable to every kind of taxpayer. So you could be an individual, a company, a partnership firm. So any taxpayer who's making a cash withdrawal in aggregate in one financial year exceeding ₹1 crore will face 2% TDS. That 2% applies on amounts beyond ₹1 crore. So the idea is to prevent you from making those kind of cash withdrawals. It's applicable when you're making a withdrawal from a bank or a cooperative society, which is functioning like a bank and or a post office, and they will make those TDS deductions. It does not apply to the bank itself or to certain government agencies, those are exempt, but most other taxpayers are going to face this TDS. Now, whenever such a situation happens that you've withdrawn more than ₹1 crore, then the person who's paying you, the bank who's paying you, will ask you if you filed your tax returns for the past 3 financial years relevant to the year in which you're making that withdrawal. So past 3 financial years, if you have not done your tax returns, then the threshold for TDS deduction of 2% comes down to 20 lakhs. So anybody who withdraws more than 20 lakhs and has not filed tax returns for the past 3 financial years will face a 2% rate of TDS, and that TDS rate will go up to 5% for such a person where the amount of withdrawal exceeds ₹1 crore. So the whole idea behind this is to ensure to curb people from making significant cash withdrawals. And also, if you're running a business and if you're making any payments which are in cash, you cannot make more than ₹10,000 worth of cash payments in a day. So really, you should not be needing so much cash, and they're trying to prevent you from withdrawing sums in cash and doing your business expenses or doing other transactions via cash, and that's the whole reason why they implemented section 194N. So taxpayers need to be very, very careful when they're making these withdrawals from banks, and make sure that they give information to the bank about any tax filing. Tell them that tax filing has been completed for the past 3 financial years, so that they don't end up facing a higher rate of TDS.
Okay, great. Well, let's take on board some questions and queries we've received from our viewers. Our very first question is coming in from Rao. He asks, is PPF interest, which is tax-free so far, is it taxable from this financial year? Well, we already got that clarified that it's not. But you know what? It sort of spurs me on to one more question, and that is the fact that, Preeti, we have 2 tax regimes to choose from this financial year, which means from April to March 2021. Now, interestingly, if I take the new tax regime, then I will not, even though I make a PPF investment, I cannot claim it for tax purposes. But does that include that even the interest I earn on PPF will be taxable? Preeti, if you could just give out that clarification for our viewers, because we know for a fact that interest on PPF is not taxable.
Right. So that's a very, very common question, and everybody has this query that I used to do PPF deposits for tax purposes. Now that the tax benefit has gone away, now that the government is not going to give me a tax benefit on ATC under the new tax regime, then what happens to all the interest income and the income at withdrawal? So both of these continue to remain tax-free. Remember, any interest income that you have from your PPF account is not going to become taxable because you've opted for the new tax regime. Even withdrawals will continue to be exempt from tax. However, it's a good way to actually look at your investments not just from the tax lens, but also look at what kind of play they have in your overall portfolio. And that's what we encourage all taxpayers to look at various instruments, not just from what kind of tax benefits they bring, but what is their place in your overall portfolio. So don't be very fixed instrument heavy in the sense of having a PPF or a fixed deposit or EPF, but look at equity related investments as well, where you may also have certain tax breaks. But for now, PPF interest income continues to be tax free even when you have opted for the new tax regime.
All right. Okay. Well, I hope all of our viewers have got this query clarified once and for all. Okay, we have Prasad who's asking us that I have already made 1.5 lakh rupees worth investments. This of course is, for the purpose of his tax saving. But he asks, is there scope for more since my income is 12 lakh rupees? So obviously, even if he makes that 1.5 lakh rupee income, tax saving investment, it's definitely not going to cover, and he will still have to pay, a certain amount of tax. So any other, is there any more room for him to, save taxes by making any more investments or payments?
Right. So firstly, I'm assuming that this 1.5 lakhs is from Section 80C and that limit has been fully exhausted. Now, assuming that you are salaried, you will get 50,000 worth of standard deduction. And if you're looking at saving towards your retirement, then NPS is an excellent option. You can open an NPS account and you will be able to deposit an additional rupees 50,000, or as much as you want. Actually, you can make a deposit and claim 50,000 rupees under Section 80 CCD 1B. That will bring your total tax deductions to rupees 2 lakhs, 1.5 lakhs under ATC, and an additional rupees 50,000 under NPS. NPS is definitely an interesting product and you should explore it because of the way it is structured. It's very well regulated, and we are looking at long-term investing and strategizing to save for your retirement. So that's another 50,000. Now, if you want to do any health insurance, you can do that as well, and that's covered under Section 80D. You can cover your immediate family, you can cover parents, and you can claim a tax benefit under Section 80D. Now, beyond all of this, there are certain specific sections where you can claim certain tax benefits. If you have dependent relatives who may be suffering from a disability, or if you're looking at an educational loan for self, or say a family member, you're making interest payments, then that can get covered under Section 80E. But largely, the pillars of tax saving is definitely ATC. That's 1.5 lakhs. If you're salaried, then you will get 50,000 worth of standard deduction. Then you can claim interest deduction when you have savings account interest under Section 80 TTA. And then you, of course, can do an NPS. You can still open an NPS account just a few days to go, but NPS account, once opened, you can start making deposits and claim additional rupees 50,000 under Section 80 CCD 1B. So these are broadly the ways to save tax now that the financial year is already closed and employers have already paid TDS. There's not much you can work with your employer in terms of your salary structure, but these are the tax savings that you can do right now.
Preeti, just a counter question over there. When you say the health insurance under ATD as well is an option, I just want to make sure that clarification for all our viewers. If you made payments from April to June or July, that will be counted for FY21 and not for FY20. I think it's important for our viewers to understand that as well. However, if you're making an NPS investment, if you make it now, that can be counted for FY20. Preeti, do correct me if I'm wrong, but I think this is the right interpretation. Am I right?
Time period which has already gone by. But if you make a payment for a health insurance right now, you're still eligible to claim it in financial year 1920. You can definitely do that. It may be for a future period, but you're allowed to claim that kind of a tax benefit. You have to file a special schedule in your tax return, which is called Schedule DI, and you can specify in that schedule how much of your ATD deduction, how much of your investment or payment you want to claim in financial year 1920, and that shall be allowed to you. Same for NPS, so you can make a deposit right now. You can choose to claim it in financial year 1920, or you may claim it in financial year 2021. Both the options are available to you. Just remember to file the Schedule DI in your tax returns and claim in whichever financial year you are okay with, even though for insurance you may be covering a period that is, of course, in the future, the financial year is already closed, but that option has been made available to you.
Okay, so I stand corrected over there. Even health insurance or Mediclaim payments made can also be claimed for FY20. I stand corrected over there. But yeah, make sure you make the proper disclosures in your income tax returns that the payments that you made in this financial year, you would like to take them for deduction purposes in the previous financial year. Okay, we're out of time on that. Preeti, really appreciate you joining us today, on the Money Show. Thanks so much for patiently answering all those questions and queries from our viewers. Well, on that note, we will take a very short break. Don't go anywhere.